Welcome to Climate Now, the podcast that explores and explains the ideas, technologies, and the solutions that we'll need to address the climate crisis and achieve a zero-emissions future. I'm James Lawler. To sign up for our newsletter, which goes out every Tuesday morning with the link to the latest episode, background information, and links, you can go to climatenow.com and subscribe there. To get in touch with us, email us at contact@climatenow.com. We love to hear from our listeners. For today's episode, we're speaking with James Regulinski, who's co-founder of Carbon Collective, an online investment company and investment advisor with a focus on climate impact. We'll get into how climate-friendly, quote, ESG, unquote, investing really is. Here's a preview.
And if it says ESG, well, what are the methodologies they're using? What companies are actually in that fund? Does that align with your understanding of what they're trying to do? And a lot of times it comes up with nonsense answers.
But first, it's time for our news segment, This Week in Climate News.
This week in Climate News, I'm joined by our managing producer at Climate Now, Emma Crow-Willard.
Hi, James.
Great to have you here.
Yeah, so this week we're pulling three specific stories out. There was a new report out of RMI talking about urban land use reform. How are we using our land? How are we permitting? Changing that can have major impacts on our climate. Also, the EPA announced its landmark limit to power plant pollution. And then finally, we'll go over the drought in Europe and the impacts that's having and how they are planning to address it.
So let's start with the Urban Land Use Reform report out of RMI. So in the report, RMI's analysts get into how changes in land use that cities might make could result in significantly lower emissions in cities in the future. Specifically, they focused on three very fast-growing U.S. metropolitan areas, which were Austin, Texas, Charlotte, North Carolina, and Denver, Colorado. And basically, they found that by making certain reforms to where different kinds of buildings are permitted, you could shorten distances between housing and people's daily needs. You could reduce building energy use and water consumption by allowing attached and multifamily housing types, as well as integrating those types with denser commercial buildings, compact urban forms. And finally, curb sprawl and preserve land to serve other needs and functions like farming or forestry, wilderness conservation, and carbon storage. The report looks at sort of two different cases for each of those urban areas. They look at a business as usual case versus a land use reform case. And the results are really quite striking, that you see just much more sort of managed development. Development is concentrated in fewer areas. You have a lot more sort of wild land that's conserved, for the betterment of the people who live there and for wildlife, et cetera, and other ecological services. Strongly recommend to anyone who works in city government or in planning to check out this report and just see what's possible by sort of thinking a little bit differently about how land use is
how we use our land.
Yeah, about how we use our land.
I was actually really excited when I saw this RMI report because we don't realize how much the planning department plays a huge role in just our day-to-day, not even just climate impacts, but our day-to-day climate impacts, our own carbon footprint. Like, do I have to drive to work? Because they decided to zone, this huge housing development with nothing nearby. No workspaces, no walkability. Like, these are things that we need to be thinking about in cities in order to seriously decrease carbon emissions.
You've lived in Denver how long?
Well, I grew up in Denver, and I actually left in 2006, but I came back in 2019. And the amount of development just skyrocketed. And with like that kind of rapid development, it's hard, I think, to plan it in a way that's more thought out and thinking about like, okay, we're going to need like transit-oriented development and designing it and incentivizing the right kind of development in the right areas.
Right. The report makes clear just how big an impact planning departments can have on cities achieving their climate mitigation goals.
And Denver, it matters a lot to Denver because we already have bad air quality because we're right up against the mountains. And so I've noticed it getting worse, that's for sure. I can't see the mountains some days. a lot of days. It's depressing.
Yeah.
Our next story is that the EPA has recently announced a landmark limit to power plant pollution.
So electric power plants currently produce 1/4 of US greenhouse gas emissions. That includes coal-fired power plants, natural gas, et cetera. So altogether, these power plants are producing 25% of our emissions. Under these proposed rules, all coal-fired power plants and the most frequently used gas-fired plants would have to cut or capture 90% of their CO2 emissions by the year 2038 or be shut down. So this represents, potentially a transformative shift for the US economy, where together, these coal and gas resources supply about 85% of electricity. So importantly, the rules don't mandate how an individual power plant must slash emissions. They just set the cap and they give a timeline and they leave it to the plant operator owners to decide how to do that. These rules are almost certain to face significant legal challenges because this is all going to mean capital expenditure.
But even with those extra costs, the EPA estimates that limiting pollution from smokestacks would produce a net economic benefit up to $85 billion by 2042 because of improved health benefits, lowering the levels of soot and sulfur dioxide from coal plants.
So the drought in Europe is coming earlier than expected. Spanish olive oil production, which accounts for 45% of the world's supply, will likely be less than half of what it normally is this season. Grains such as wheat and barley projected to fall as much as 60%. So these are some major impacts that are coming more quickly than many expected.
So as a part of this, the Spanish government is going to spend over 2 billion euros on new water supplies, subsidies, direct aid to farmers in order to try to alleviate this drought. This is the driest start to a year on record since recording began.
And it's important, I think, for everyone to sort of take stock of the fact that this is just the tip of the iceberg. We're just seeing the beginnings of something that is happening around the world at accelerating pace with increasing devastation every year. More on that in both Bloomberg and Reuters this week.
Now it's time for our interview segment. James Regulinski studied engineering in college before going to work at several environmentally focused startups, including a company working on gasification of organic matter to generate electricity. About 2 years ago, James co-founded the climate-focused investment advisor Carbon Collective. Over the course of our conversation, we'll discuss the landscape of environmental, social, and governance, or ESG, investing and how Carbon Collective's approach differs from that of larger money managers like Vanguard. We'll discuss Carbon Collective's theory of change, as well as the historic returns from clean energy companies. Finally, we'll get into some of the arguments for and against divesting from fossil fuels, and why Carbon Collective views divestment as an important tool in combating climate change. James, welcome to Climate Now. It's great to have you on today.
No, thank you so much for having me.
So tell us, what is Carbon Collective? What do you guys do?
Carbon Collective is an online-only investment advisor. And we started out with this goal of how do we move as much money as we can from the current economy into one in which we are solving climate change. Now, the one in which we're solving climate change is one that's been modeled out by people who've been doing this for a long time, like Project Drawdown, which we drew a lot of inspiration from. And there's a kind of a clear path of what we need to do. We need to stop investing in any new oil and gas infrastructure. We need to be investing very heavily to the tune of $5 trillion a year in technologies that will transition us away from that, make our economy non-dependent on that. And we need to do this fairly quickly. But all those models, both like what Project Drawdown has done, what the International Energy Association and other models of sort of what do we need to do as a society scope, they generally rely on existing technologies in those models. So we're not looking at a moonshot. We're not looking at, we have to get fusion up and running to solve this problem. It's saying, with the technologies we have today, what would we have to do? And that's how you get to those numbers around sort of the $5 trillion a year investment. But that means that we need investment from a lot of different sources happening relatively quickly. And at the time when we started the company, we didn't see that happening on a government scale. That's one way in which we make large changes. We sort of say, collectively, what are we doing with human resources, intelligence, time? Government policy shapes that. I joke that the other big one is religion. But in the US, it's economic forces. It's how do we invest? And the investments that we as individuals have is small when we think about our own money. It's often, we're not talking about trillions of dollars. We're talking about hundreds of thousands, maybe millions if we're lucky. But when you look at all of the money that's invested in 401ks and in IRAs, that money does start to make a difference. And it is at the magnitude that we're talking about. However, it also will start to leverage, it can change the narratives around investing. And those narratives then shape how other money, how institutional dollars are invested and so forth. So that was the impetus for why Carbon Collective. Now, what Carbon Collective does for an individual is maybe a little bit different than why we started it. So as an individual, we have the same mission. We're still divesting your money from fossil fuels, proactively investing in climate change solutions, but we're also helping you create financial security. We're helping businesses and companies deal with the complexities of having a 401k while offering better perks to their clients. So we have both the larger mission saying, this is what drives us. This is our passion. This is what we know needs to happen in the world. But we also know that every individual has that tension. They have the imagined world they want to live in. This is the world in which we solve climate change. And they have the realities that we currently live in a system, a capitalist system that requires them to be proactively saving and investing if they want to retire, if they want to have that security net.
Yeah. So James, how does Carbon Collective differ from, let's say, a platform like Vanguard or some of the others that allow you to choose sort of an ESG oriented basket of assets to put your funds into?
Yeah. So ESG is an unregulated term, and it means a lot of different things to a lot of different people. And so it's a hard term to look at and be like, I see ESG, therefore I know they are doing what I expect them to be doing. Now, people have internalized, most retail consumers, retail is the technical, the financial term for like the average person investing. You're not an institution, we're retail investors. We see that and say, if I invest in ESG, I'm investing in making the world better. The reality is ESG can mean anything from I'm proactively screening out bad companies, I'm proactively putting in good companies, but it can also mean I've taken into consideration the downside risks of environmental, social, and governance concerns on this stock. So like, what is the risk that, of climate change to this company being able to do its core business? Well, the risk to a company doing its core business as a relation to climate change has nothing to do with building the world that we want to live in. It has nothing to do with making a better world. It has nothing to do with the ethics of the company. And that is a permissible use of the term. I think in the most extreme cases where we think of it as the most greenwashing, it is simply the acknowledgement. And then it runs the gamut of the acknowledgement. They have a plan. They're taking into consideration. They've taken steps. They're the best or worst performer within a category. So like the best performing oil company when it comes to environmental, social, and governance concerns. Now, I don't see a plausible model for us solving climate change, any credible model in which we continue expanding fossil fuel production at this point.
Right.
So saying that you are the best within that field doesn't really help us on this larger question around investing in a sustainable and environmentally appropriate way. And I think that's what I recommend to people when they look at what they're investing in. If it says ESG, well, what are the methodologies they're using?
Right.
What companies are actually in that fund? Does that align with your understanding of what they're trying to do? And a lot of times it comes up with nonsense answers.
Right. It's kind of like you have this train that's hurtling down the tracks toward us, and you have two options: one, to invest in companies that directly stop the train, and the other, to invest in companies that acknowledge the existence of trains.
That's a remarkably good analogy. I'd only put out that unlike other environmental problems that we faced in the past, like this is a problem where we kind of need to be building a second rail. Like we're on tracks that are going towards a cliff, and we kind of need to build another set of tracks to move the train a little bit, because there's nobody's stopping this train.
Right.
The train's going to keep moving. And when I say that, I mean like literally the status quo is bad for the environment, and everything that would shift our economy away is more work. Like we are going to be building new things, new infrastructure, new buildings, changing existing infrastructure, building out more energy production, energy storage, transportation. Like these, it's an investable, it is a proactive act.
So James, how is Carbon Collective different in terms of its approach to identify companies that are actually working on solutions to the climate crisis?
Yeah, so I'll start with our basic portfolio theory of change, which is you divest from fossil fuels and you proactively invest in climate solutions, and then you use shareholder pressure to encourage companies, to put pressure on companies to be changing what they're doing faster. And so those are the three ways we see money has power in being able to shape what's happening in this transition. You can just take money away from, make the cost of borrowing higher, make the cost of borrowing lower, make these other investments more attractive, allow for a pipeline to pull companies sort of out of the private sector into the public sector, give them an end state there. And then shareholder advocacy, which is the right to vote on a share that you own around a limited set, but still important set of issues. Mm-hmm. That is our theory of change. Mm-hmm. On that proactive side, which I think is very critical and different than what a lot of other companies are doing, is we are looking at the companies that are building the technologies that let all the other companies make the transition. When we look at, again, Project Drawdown and International Energy Association's study on how we transition our economy, they call out particular technologies. And these technologies are ones we need to be investing in if we're going to be no longer dependent on fossil fuels. So some of them are obvious. They're like wind, solar, battery energy storage, energy infrastructure. Some of them are a little bit less obvious. There are things like intelligent buildings, having more efficient built environments, capping landfills, having a circular economy, being able to recycle more things like refrigerants we don't think about a lot, but are critical in being able to address climate change, reducing food waste. So it's quite broad in its scope of kinds of solutions. And we include all of those. And we don't look at whether a company claims it will do some work in this space. We don't look at their ESG report. We look at their 10K. Their 10K is the SEC regulated filing in which they say things like where they get their revenue from. And we look at, did over 50% of their revenue come from one of the solutions identified in one of these sort of scientifically backed models on what we need to be doing? And if it is, then it is a company that's primarily working on a climate change solution. And so that to us has a lot more weight than the CEO saying we're making a claim to net zero. I mean, net zero has a lot of problems inherent in itself, but even making that claim, it's a non-binding claim.
What is the specific offering to Carbon Collective customers?
Yeah, so we have several different customers we offer products to. So for companies, we offer 401k plans for their employees. And if you're an employee of a company, well, you can't directly work with us on your 401k product because that is something that is offered by your company. You can advocate to have a climate forward option in your 401k. And if they are unable to provide that, you can pressure your company or encourage them to look for a 338. That is someone like Carbon Collective who will build those portfolios for your company and help manage that and make that a reality. Most individuals save for retirement through their 401k plans. It can be really effective. So we see a lot of folks having that be their primary way of saving. So this is a powerful way that you can have your investments working in climate forward fashion, is advocating with your company. Or if you own a company or the HR representative company, being able, the decision maker, you can help make that happen even more quickly. So that's our first offering is for companies. We build these same climate focused portfolios that we've been describing earlier. We also have that for individuals. So if you just want to save in your IRA, which is an individual retirement account, or a just general investing account, we, in the same way that other robo platforms offer the ability to automatically invest in their portfolios, we offer that to individuals. So you can sign up on our website. You can either transfer over an old account or start a new account, deposit money. That money is automatically invested into our climate forward portfolios. And you can be saving for your retirement or other financial goals in that way. We keep the fees very low because this is a hands-off fashion. So we charge either 20 basis points or 5 basis points for the different portfolios that we offer. And that's because so often what we see is that environmentally forward investing has a premium put on it. And that premium isn't always reflected in like the amount of impact that's happening. And this greenwashing, because how much impact you have or what environmental investing means or climate forward investing means is unregulated. What we see is a lot of greenwashing in the space. And that greenwashing means that you are having less of an impact and you're paying more for it. So you're having even a higher drag on your portfolio. You could argue that paying more is worth it if you are having a positive impact, but we see a lot of funds that come out that are taking advantage of this trend without sort of substantiating their claims or having a really compelling argument that backs it up. Those kinds of greenwashing are often, they outsource the ethics of the question to somebody else. So what we saw with BlackRock's low carbon transition fund is they use MSCI data. That data is, provided by a third party and allows them to give rankings to each of the companies in their portfolio. But what they end up with is a 70% overlap with the S&P 500. And it's being charged, they're charging 4 to 5 times as much as just buying an S&P 500 and making claims about how green it is as a result of having this lower MSCI score or having zero coal in their portfolio and not really doing diligence beyond that. So they do hold Berkshire Hathaway, which is one of the largest coal holders, public investments in the US. So they are definitely trying to get on this bandwagon of showing that they are offering a green option or an environmentally forward option and charging more for it, but not really backing that up. So for us, it's not only important to offer our client something that is very clear and transparently how it makes a positive impact, but then also keep our fees as low as we can so that we're not having that drag on their portfolio and they are able to build up their retirement over time with a real impact to back it up.
What is your AUM at this point?
So currently our AUM, when you look at all of our business sectors, is over $50 million. And while this isn't yet the amount that is going to change the world, there are a lot of stair steps that occur where you hit certain thresholds in AUM and then it opens up other larger packs of investments. So we are really just keeping our heads down and pushing as hard as we can to hit each of those different gates. And as we do, we hope that we do bring as much money as is needed to bear on the problem.
Okay. Can you tell me a little bit about historic returns for these companies versus a traditional like an S&P basket or, a fossil fuel intensive portfolio?
Hard question to answer in a compliant way. I can talk about companies in general. Our portfolios in particular, we've only been around for 2.5 years. So we don't have true data on live accounts that I can share.
Yeah.
When we do back testing, there are known issues with it, in particular survivorship bias, which is the most common, which makes portfolios, when you back test them, look like they are more successful than they would have been if you had modeled it at the actual time and then tested forward.
Right. Because some of the companies would have failed, but you're only looking at ones that succeeded. Right.
Right. And it's very easy to overlook companies that failed that you didn't hear about, et cetera. So we try to correct for it, but again, it's limited. When you look at that on our models, you can see exceeding market performance and in particular circumstances by substantial amounts. Mm-hmm. However, I'd be very cautious of saying that is actually what people should expect in short term, especially. Now, because some of that period was really abnormal. Like if you look at 2020, it was a weird year and we saw really high performance. Now, if you looked at our stocks during 2022, it would have been really poor performance, even slightly below what you might see from the baseline from the S&P 500. However, I also want to point out that if you looked at just an index investing, if you looked at with and without oil stocks in it. So that's one way of looking at our core portfolio is like, well, what if you invested in the total market, but you just cut out the worst actors? What does that do?
Okay.
Well, over the last, I think it's 2 decades, oil has been essentially flat. Oil, gas, coal has not performed particularly well. Even with the current upswing from the Ukraine war, I think we're looking at a couple percent gain. Now, there are spikes, of course, and I'm sure that if you look at just the right section, you can make a really strong case over the short term for oil and gas. Mm-hmm. But it has not actually been an incredibly lucrative investment. So if you look at it from that perspective, divesting from fossil fuels and adding in these higher growth companies that were, solar, the price of solar has fallen dramatically and companies in this space have grown a lot. That's the same. It's true of electric cars. We've reached peak cars. The only growing sector in passenger automobiles right now is electric vehicles. They're eating more and more of the market share. So the companies that have been in that space have performed disproportionately well. And so those things all help sort of support like this case that investing in this transition has positive return potential. Positive return potential. That's a really protective way of sort of shielding me, but it's saying that there is a world in which we do all this work, we make this transition, and there are a lot of gains. You can make a lot of money. I would never promise that because investing is not a guaranteed thing. And we saw, especially in short term, with things like the Ukraine war and inflation and what the SEC is doing, that portfolios, you can lose a lot of money as well. It's a risky venture. But in terms of trends, that's what I'm seeing.
Yeah. James, what are some of the views on divesting from fossil fuels, pro and against, and why do you think that Carbon Collective's view makes the most sense?
It's a great question. So let me start with the why you shouldn't divest one.
Why you should not divest from fossil fuels. Okay, we'll start there.
This is not the Carbon Collective take, but there have been folks who make this claim a lot.
Yes.
And there's sort of a couple groupings of arguments. One is the seat at the table argument. That is, you own shares. If you own shares, you can vote on issues. If you own enough shares, you can put someone on the board. Engine number one did this with ExxonMobil, made a big splash around it. And the idea was if you put the right people on the board, they could make a difference in how the company is run. And that ExxonMobil is a large company with big lever arm, and making a small change on a large company could still have very large impacts. Mm-hmm. So that's the seat at the table argument. The second one is it's a secondary market. It's not like I buy shares directly from the company and they have more money in their pocket in the same direct way. Now, from an accounting sense, how much money they can borrow, what their finances look like, they are affected. And that's, I think, an important thing to remember. It's not emotionally as satisfying. But from a direct sense, you're not directly putting money on. And you sell a share, someone else buys it. Mm-hmm. And so the question is, are you actually hurting the share price enough to reduce their borrowing power? Mm-hmm. And if you're not, then you're just missing out on the opportunity of being invested in that company. You could be making those dividends and putting those dividends to other use. I got this advice a lot when I was a kid, when I just started out investing right after college. I was looking at ethical impact investing, and everyone kept saying, James, invest in an average index and then take the excess earnings and then donate them. Mm-hmm. I hated that advice for a whole host of reasons, but it was a very strongly held belief. And I think that's sort of reflected in one of the current it doesn't make sense to divest. You can use that money for more good if you make more money. Mm-hmm. Those are the pro staying the course, let's say.
Right.
Now, what I believe, what the Carbon Collective view has sort of addresses each of those in turn. The first is on the engine number one, can you make a difference with ExxonMobil? And what we've seen is they got 3 board members, I think, and there's 11 board members total, maybe 15. So not that many people. And we haven't seen any of the major things we'd want to see happen. We haven't seen massive new investments in changing over the business structure. We haven't seen really a phase out plan. We haven't seen a stop of exploration. So the question is
what are they doing?
What are they doing? Going a little bit of a tangent here. These are companies that have deeply invested in undermining the story around climate change. We have the science on climate change was not polarized, was not really ever contradicted. And this is from the 70s. And it's been a large investment of these companies for a long time. It's deeply embedded in their company culture to essentially say that is a false story. And then even when they engage with it now, and they are engaging with it, but oftentimes when you look at how much they're investing to how much they're investing in new fossil fuel infrastructure, it's dwarfed. You have a 0.5% or something, or percent being invested into these new transitionary technology. And so it's just not really commensurate. So saying that you investing in supporting those companies and making these small changes as having a large impact, I think is suspect. And that comes to the next thing that I think that we believe, which is anything you're doing with your money, you could be doing something else. Mm-hmm. And it's not just that you're invested in oil, it's that you're not invested in making it easier for these other companies to raise capital, making it easier for them to help pull companies into the public sphere. So the next way is on the cost of capital side that I was talking about. So if you can make the cost of capital easier to raise, and there's 2 ways that this happens. One is as that sort of it feels like a magic hand wavy on your balance sheet when the share price goes up, your ability to raise money is greater. And there's also direct sale that happens. So the best example I have this was Plug Power. In 2020, their share price shot up. And when it did, they sold additional shares of the company. And they raised about $1 billion to build out green hydrogen infrastructure. That was the share price went up. We as investors said, we believe in this. We're going to support the share price. As a result, they raised a bunch more money and they used it to directly do the work they were trying to do. And the third, when we are saying that these companies, this class of companies are more valuable, we're going to pay more for their shares. It does a couple things. It sends markets down signal. And I've mentioned this a couple times. If you are a VC investor or a private equity investor and you're investing in an early stage company, you're more likely to invest in them if there's an exit strategy and something that will justify the price you're paying for it. So if you don't see any public companies with, strong share prices that are in that space or are similar, it's going to be sort of hard to justify. Like if you don't believe that they can exit with a good price, it's going to be hard to justify investing in them.
Right.
So when we're in the public markets, and as a retail investor, I can't invest in private companies directly. There's a few exceptions, but for the most part, I can't. So one thing I can do is in the public companies, be investing, sort of sending that signal downstream. Mm-hmm. The other is just in the narrative about what is valuable. And the other way that we borrow money is based off what stories are being told, what's going to have growth potential and what's not. And the stock market is kind of a collective storytelling exercise. Right. I know it sounds a little bit wishy-washy, but at the same time, when you look at the meme stuff, but it is like it's emotional. We're all saying like, I believe this is going to happen in the future.
Right.
And so I'm saying intentionally, we want to create this story about the future, makes that story more likely to come to fruition.
Yeah. Really interesting. Well, James, thank you so much for your time today. This was very, very interesting and helpful and inspiring. So appreciate it.
James, thanks for taking the time and creating such an interesting space and dialogue.
That was James Regulinski of Carbon Collective, talking about the company's approach to climate-friendly investing. That's it for this episode of the Climate Now podcast. For more episodes, videos, to sign up for our newsletter, or register for an upcoming event, visit climatenow.com. We hope you'll join us for our next conversation. Climate Now is made possible in part by our science partners like the Livermore Lab Foundation. The Livermore Lab Foundation supports climate research and carbon cleanup initiatives at the Lawrence Livermore National Lab, which is a Department of Energy applied science and research facility. More information on the Foundation's climate work can be found at livermorelabfoundation.org.